The widow's tax trap. What happens to your taxes when your spouse dies? I want to talk about something today that isn't easy to think about, but it matters more than almost anything else we cover on this channel. Here's the number that surprises people the most. A surviving spouse's tax bracket can nearly double the year after their husband or wife passes away, even if the household income barely changes at all. That's not a typo, and it's not because anyone did anything wrong. It's simply how the tax code treats a single filer compared to a married couple. And because almost no one is thinking about tax brackets in the middle of losing a spouse, this trap catches people at the worst possible moment, when they have the least energy to deal with it. So here's what we're doing today, friend. I'm going to walk you gently through exactly why this happens, share a story about a woman named Carol who went through this herself, and give you 3 things every couple can set up now, while you're both here, calm and thinking clearly, so that if this day ever comes, it's one less burden to carry. Before we get into it, if you haven't already, go ahead and hit that subscribe button. I put out a new video like this every week, walking through exactly the kind of retirement money situations that don't get talked about enough. And if you have a spouse, or you know a couple who could use this, please consider sharing this with them. This isn't the most comfortable topic, but it's one of the most important ones I cover. I'm Anne, and I've spent years helping people make sense of what happens to their money at every stage of retirement, including the stages nobody wants to think about. Let's talk about what actually happens to your taxes when a spouse passes away. Why the tax situation changes so abruptly. Here's the part that catches people off guard. In the year your spouse passes away, the IRS still generally allows you to file as married filing jointly for that year, assuming you haven't remarried. That softens the blow, at least for that first year. But starting the very next year, your filing status changes. In most cases, you move to filing as single. And in some situations, if you have a dependent child, there's a special qualifying surviving spouse status available for a couple of years that can help. But for most retirees whose children are grown, that doesn't apply, and single is where you land. Now here's why that matters so much, and let's slow down and actually look at the mechanics, because once you see the shape of it, it stops feeling confusing and starts feeling obvious. When you file as single instead of married filing jointly, 2 big things shrink. And they shrink by roughly the same proportion. First, your standard deduction, the amount of income that isn't taxed at all before anything else even applies, is roughly cut in half. Second, and this is the part people really don't expect, the income ranges for each tax bracket are also roughly cut in half. Think of it like a set of shelves. When you're married filing jointly, your income gets spread across a set of wide shelves, each one holding a good amount of income before the next higher tax rate kicks in. When you become a single filer, you're given the exact same shelving system, but every shelf is now roughly half as wide. The same amount of income that used to spread comfortably across 2 or 3 wide shelves now has to squeeze into shelves half that size, which means more of it spills over onto the higher shelves, taxed at higher rates. Picture a married couple with a certain amount of income landing comfortably in, say, the 22% bracket, with plenty of room left on that shelf. The next year, if the surviving spouse has that same amount of income, same pension, same Social Security, same required withdrawals from retirement accounts, that income now has to fit into brackets that are roughly half as wide. The same dollars that used to sit comfortably in a lower bracket can suddenly spill over into a much higher one, sometimes 2 brackets higher, without the household spending a single extra dollar. And it's not just brackets. Required minimum distributions from retirement accounts are calculated based on the account balance and your age, regardless of filing status. So a surviving spouse can be required to pull out the exact same dollar amount from an IRA as before. The RMD doesn't know or care that a spouse passed away. But now, that same required withdrawal lands on top of a narrower bracket structure and gets taxed at a noticeably higher rate simply because the shelves got smaller. There's another piece to this, too. If your household income drops because one Social Security check goes away, but your other income, pensions, RMDs, investment income, stays the same, the total picture doesn't always drop as much as you'd expect. Meanwhile, the tax brackets you're measured against got smaller in that same year. So even a lower total income can end up taxed at a higher rate than before, which feels backwards until you see the mechanics behind it. This is why so many surviving spouses tell me the same thing. My income actually went down, so why did my tax bill go up? It's not a mistake on their part, and it's not something a tax preparer did wrong. It's simply how the numbers interact once the filing status changes. Carol's story. Let me tell you about Carol. Carol and her husband Richard had a straightforward, comfortable retirement. Between his pension and both of their Social Security checks, along with modest required withdrawals from their retirement accounts, they lived well within their means and always filed their taxes without much drama, year after year, like clockwork. Richard passed away in the spring after 41 years of marriage. Carol handled everything with grace, and that year, filing jointly one final time, her taxes looked roughly the way they always had. The wider shelves were still there for that final joint return. But the following year, everything shifted. Carol still received her own Social Security, plus she now received the higher of the two survivor benefits instead of both checks separately. Richard's pension continued to her as a survivor benefit too. Her required minimum distribution from the retirement account stayed about the same since the account balance hadn't changed much in that first year. On paper, her total income had actually gone down slightly compared to when Richard was alive. And yet, when she filed her taxes as single that following spring, her accountant delivered the news gently but plainly. Her tax bill was higher than it had been the year before, even with lower income. Carol told me, and I remember exactly how she put it. I didn't understand how that was even possible. I was earning less, not more. What happened was exactly the mechanism we just walked through. The same income that used to spread across two people's worth of tax brackets was now squeezed into brackets built for one person. Nothing about Carol's spending or her lifestyle had changed. Only the shape of the tax brackets around her had changed, and nobody had warned her that would happen. Carol wasn't careless, and she hadn't missed some obvious warning sign sitting in plain view. This simply isn't something most people think to plan for, because it only shows up after the hardest part of the year is already behind them, when they're least prepared to absorb another surprise. The 3 things to set up now. So here's your framework, friend, and this one is especially valuable to go through together as a couple, while you both can sit down calmly and think clearly. Number 1, know your filing status timeline in advance. Understand that the year of a spouse's passing generally still allows married filing jointly, but the following year usually shifts to single. Just knowing this timeline in advance removes the shock of it. If you're the healthier or younger spouse, it's worth quietly reviewing what your own tax picture might look like as a single filer, using today's income numbers as a rough estimate, so there are no surprises later if that day ever comes. Number 2, consider Roth conversions while you're still filing jointly. This is one of the most practical things a couple can do together, while those wider shelves are still available to both of you. Converting some traditional retirement account money to a Roth IRA during these wider bracket years, paying the tax now while the brackets are more generous, can reduce the size of future required withdrawals that would otherwise get taxed at a surviving spouse's narrower, higher rates down the road. This isn't right for every situation, and the numbers matter a great deal here, so it's worth reviewing with a tax professional. But it's a conversation worth having now, rather than never. Number 3, review your Social Security survivor benefit election together. When one spouse passes, the survivor generally receives the higher of the 2 Social Security benefits, not both combined. Understanding which benefit that will be and how it interacts with the rest of your household income and the narrower brackets we just discussed helps you both see the fuller picture of what income will actually look like for whichever of you ends up being the survivor, and plan accordingly, rather than finding out in the moment the way Carol did. Have the 2 of you actually talked about this together? Most couples haven't, simply because it's not a comfortable conversation to start. But having it now, calmly, over coffee, is a genuine gift to whichever of you ends up navigating it alone. Recap. Let's bring this back together, gently. The year after a spouse passes away, filing status typically shifts from married filing jointly to single, and that shift roughly cuts both the standard deduction and the tax bracket ranges in half. That means the same income, sometimes even a smaller income, can end up taxed at a noticeably higher rate, exactly the way it did for Carol, simply because the shelves got smaller while the income stayed roughly the same. Know your filing status timeline. Consider Roth conversions while you're still filing jointly, while those wider brackets are still available to you both. And review your Social Security survivor benefit together, as a couple, before it becomes urgent. Here's what I want you to hold on to, friend. None of this is about assuming the worst or dwelling on loss. It's about making sure that whichever of you is left navigating this eventually has one less complicated, confusing thing to figure out during an already difficult time. That's not morbid, and it's not pessimistic. That's love, expressed through preparation. If this video helped you see something you hadn't considered before, do me a favor. Hit like on this video, subscribe if you haven't already so you don't miss next week's video, and gently share this with a couple you know who could benefit from having this conversation now, while they still can, together. I'm Anne. Thank you for spending this time with me today, and I'll see you in the next one.